Latin America is very much on the map right now for private equity, and after a record 2021, there has been a slowdown, but this year is still on track to be the second biggest in terms of deals.
One day after Austin Hurst worked a grueling 35-hour Mother's Day weekend behind the grill at Red Lobster, he found out he'd lost his job.
Just seconds ago, I was matrix dodging bullets outside of here, the offices of Blackstone, one of the biggest alternative asset managers in the world and a place with a Bond villain-ass name.
We delve into the topic of private equity embodies an appealing premise in theory. These investment funds pool capital from investors, acquire struggling or burgeoning companies, revamp their leadership and operations, boost their overall worth, and eventually sell them at a profit. On the surface, it seems like a straightforward formula for success. Consider the case of Yahoo, once a titan of the early internet in the early 2000s with a market capitalization surpassing $125 billion, more than Amazon and Apple combined at the time. However, its trajectory took a downturn after spurning Microsoft's $44.6 billion acquisition offer in 2008. Subsequently, Yahoo's value dwindled, culminating in its sale to Verizon for a meager $4.8 billion. Verizon, in turn, merged Yahoo with AOL, acquired for $4.4 billion, but ongoing losses prompted the sale of the combined entity for just $5 billion. Enter Apollo Global Management, a prominent private equity firm previously led by Leon Black, who faced scrutiny over financial dealings with Jeffrey Epstein. Apollo, renowned for its transformative approach with companies like ADT, Chuck E. Cheese's, Qdoba, and AMC Theaters, perceived potential in revitalizing Yahoo. Private equity's allure lies in its promise to unlock value, streamline operations, and position companies for growth. Yet, the practice isn't without controversy or challenges. Critics argue that the pursuit of short-term gains sometimes comes at the expense of long-term sustainability and employee well-being. Nonetheless, for investors and firms adept at navigating market complexities and operational intricacies, private equity remains a potent mechanism for reshaping corporate fortunes and generating substantial returns. To execute their strategy, Apollo needed a capable leader and chose Jim Lanzone, an experienced businessman known for turning around Ask.com. Under his leadership, Ask.com shifted from a search engine to a Q&A platform, stabilizing the company despite being overshadowed by Google. Lanzone also led CBS's digital business through its merger with Viacom and briefly served as CEO of Tinder. Apollo and Lanzone began by selling valuable yet non-core assets. Yahoo Japan was sold to SoftBank for $1.6 billion, and Edgecast was sold for $300 million. These sales helped Apollo recoup much of their investment. Next, they faced the reality that Yahoo was no longer a major search engine, homepage, or email provider. Instead, they focused on Yahoo Finance and Yahoo Sports, both of which had strong reputations. They hired Ryan Spoon, with experience at ESPN and BetMGM, to lead Yahoo Sports, and Tapan Bhatt, former chief product officer of NerdWallet, to head Yahoo Finance. Each division was given autonomy to innovate and grow. Yahoo Sports expanded its sports betting offerings by acquiring startup Wager, while Yahoo Finance grew its subscription services, reporting over 2 million customers and significant growth. This transformation, marked by shedding non-core parts and strengthening key areas, appears successful. Although private ownership means less transparency, indications suggest Yahoo is healthier than it has been in years, with profitability and plans for an IPO. Apollo's strategy seems to be paying off. They took a risk, appointed a capable leadership team, devised a viable strategy, and revived a struggling company. This success story aligns with the positive image the private equity industry likes to project. Structurally, private equity firms are simple. At their core are general partners, typically well-connected and experienced individuals. For example, J.W. Childs Associates was founded by John W. Childs after a successful career at Thomas H. Lee Partners, which was founded by Thomas H. Lee following his tenure at the First National Bank of Boston, where he became vice president. Other examples of private equity general partners include Mitt Romney of Bain Capital, who was the 2012 Republican nominee for president, and Stephen Schwarzman of Blackstone, the 34th wealthiest person in the world. These connections are crucial for the next step, raising money. Typically, general partners start by investing a few million of their own money to show their commitment. They then pitch to investors, highlighting their expertise in a particular industry. For example, John W. Childs of J.W. Childs Associates likely emphasized his success in the consumer food and beverage sector, such as the Snapple buyout at his previous firm, which was bought for $135 million in 1992 and sold 2 years later for $1.7 billion. He might argue that the food and beverage sector is a stable investment, less susceptible to market fluctuations than tech. This stability is attractive to the core private equity investors, such as insurance companies like Northwestern Mutual or employee pension funds like the Bayer Corporation Master Trust. While individuals can theoretically invest in PE funds, they need enormous wealth, with minimum investments often upwards of $25 million. Private equity firms themselves make money consistently by taking 2% of all managed funds annually as a fee, regardless of investment growth. To incentivize returns, they set a benchmark or hurdle, typically around 7%. Any earnings above this hurdle are subject to a 20% performance fee. For example, if a $100 million fund grows to $110 million, $3 million would be subject to the performance fee, and 20% of that, or $600,000, would go to the firm. The 2% base fee covers operating costs like office rent and salaries, while the performance fee can vary significantly, providing substantial earnings in profitable years. The performance fee, considered capital gains rather than traditional income, is taxed at around 20% instead of the 37% for traditional income, incentivizing general partners to maximize returns. To amplify potential earnings, private equity firms often rely on leveraged buyouts, using borrowed money to purchase companies. For example, a $100 million fund could buy a $400 million company with 75% borrowed money. This leverage magnifies potential gains and losses, significantly impacting the general partner's income with even small growth margins. For instance, with a 7% hurdle and 7.5% growth, 20% of the margin above 7% on a $400 million company would earn the general partner $400,000. If the growth reaches 7.75%, the earnings jump to $600,000, illustrating how leverage amplifies income. Not all leveraged buyouts lead to success. For example, Marsh Supermarkets, a regional grocer, faced a decline after its acquisition by Sun Capital. Marsh, established in 1931, expanded across Indiana and Ohio, but struggled in the 2000s. Sun Capital acquired Marsh in 2006 for $88 million in cash and assumed $237 million in debt, aiming to flip the business or sell its real estate assets. Under Sun Capital, Marsh underwent cost-cutting measures and asset sales, including a sale-leaseback of the company headquarters. These moves provided short-term financial flexibility, but ultimately burdened the company with escalating leases and debt. Despite initial improvements, Marsh couldn't sustain growth and filed for bankruptcy in 2017, closing all locations. Sun Capital, despite facing financial losses, continued to accrue management fees and earn commissions from asset sales. However, the true victims were the consumers and employees who lost access to local grocery options and suffered from pension shortfalls. Sun Capital's ownership worsened Marsh's decline, mirroring a pattern observed in numerous private equity takeovers. Private equity often targets sectors such as regional grocery chains, casual dining establishments, and healthcare. While their goal is efficiency and profitability, the human toll can be severe. Layoffs, diminished service quality, and bankruptcies are frequent outcomes. For instance, Nursing homes owned by private equity experience higher mortality rates, and companies acquired through leveraged buyouts are statistically more likely to go bankrupt. These consequences stem from reducing complex human organizations to financial metrics, prioritizing short-term gains over long-term stability. While some success stories exist, the prevailing reality involves price hikes, lobbying efforts, layoffs, and financial maneuvers that prioritize immediate returns over sustainable growth, often at the expense of people's livelihoods. Exploitation becomes straightforward without emotional attachment. When decisions are made by someone who directly interacts with their employees daily, profiting from their suffering becomes challenging. They must confront the repercussions of their actions firsthand, which is discomforting. However, when decisions are made by executives removed from the day-to-day operations, where each layer of management insulates them from direct consequences, exploitation in pursuit of profit becomes more feasible. At the top of the hierarchy, general partners have strong incentives to exploit marginal gains. Their compensation model emphasizes growth at any cost. Failure to achieve robust growth means they don't receive their share. With a substantial portion of profits, 20% of performance over a specified hurdle rate, flowing back to the firm, even minor adjustments, like outsourcing HR to a cheaper but less effective provider, can significantly bolster the general partner's annual earnings. These incentives drive behaviors that may seem ruthless, shielded by layers of corporate structure. Furthermore, the U.S. government's tax policies often favor these financial gains, treating them as capital gains rather than ordinary income, resulting in lower tax rates. For those occupying the role of general partner in an American private equity firm, this framework presents an advantageous environment.